A wallet opens. Inside, the bills look the same. Same faces, same colors, same numbers, but the reaction they get is different. The cashier hesitates, then shakes their head. The price has changed again. What you're holding isn't enough anymore. Yesterday, this was money. Today, it's memory. Around you, the world hasn't panicked. Stores haven't closed. There are no soldiers in the streets. People still show up to work, still plan for weekends, still assume tomorrow will resemble today. But something essential has already failed. Not overnight, not violently, quietly. Collapse doesn't begin with chaos. It begins with confusion, with the moment you realize effort and reward are no longer connected. Just years earlier, this currency was considered reliable, stable, protected. So what happened in between? How does value disappear while life keeps going? Collapse rarely announces itself. There is no single day where everything breaks at once. No headline that clearly says this is the moment. Life continues. People wake up, commute, argue, shop, plan for the weekend. On the surface, everything looks familiar. The damage happens underneath. Small changes at first, prices rising a little faster than wages, rules bending quietly, promises being stretched. Each shift feels manageable on its own, easy to ignore, easy to explain away. Governments call it temporary. Experts call it adjustment. And because daily life still functions, people assume the system does too. But stability doesn't disappear suddenly. It erodes, slowly, invisibly, until one ordinary day, something small stops working and reveals that everything else already has. By the time the collapse becomes obvious, most choices are gone, not because people were asleep, but because collapse doesn't arrive loudly. Most people don't realize it's happening until it's over. The people who survive these moments are rarely the ones who saw them coming. They didn't predict the date, they didn't call the top, they weren't watching charts or waiting for a signal. In fact, many of them didn't even understand the full mechanics of what was happening. What they understood was simpler. They knew that systems fail, that currencies change, that governments make promises they eventually can't keep, and instead of trying to outsmart the future, they positioned themselves so the future couldn't wipe them out. History is full of experts who were right too early, right too late, or technically correct and still ruined. Being right doesn't protect you in a collapse. Timing rarely saves you. Positioning does. The survivors weren't predictors. They were pattern readers. They noticed what kept repeating across centuries and adjusted their lives around those truths. They didn't see the future. They prepared for patterns. Germany wasn't the exception. Neither was Argentina. Different languages, different governments, different excuses. But when the systems broke, the outcome was identical. In Argentina, people went to sleep with money in the bank and woke up unable to touch it. Accounts frozen, withdrawals blocked, dollars forcibly converted into pesos at a rate chosen by the government. Overnight, savings lost most of their value. Not because people made bad choices, but because the rules changed after the fact. Just like in Weimar, officials insisted it was temporary, necessary, controlled. They always do. But history doesn't care about explanations. It only records outcomes. When trust in money collapses, geography stops mattering. Europe, South America. Different centuries, same pattern. Paper promises fail. Institutions protect themselves first. Ordinary people pay the price, 10 francs place. Same ending. America is not outside this story. Every collapse believes it's different while it's happening. More advanced, better managed, too big to fail. The numbers grow quietly in the background while confidence stays high, debt expands. Money is created faster than real value. Institutions stretch themselves thinner, assuming tomorrow will look like yesterday. And for a long time it does. Markets keep moving. Paychecks keep clearing. The headlines stay calm. Stability becomes a feeling, not a fact. Just like before, the warning signs aren't dramatic. They're technical, boring, easy to ignore unless you've seen them before. This isn't a prediction, it's a placement on the timeline. Every collapse looked stable until it didn't. Most people look for tactics. They want instructions, a list, a trade, something specific they can do right now that feels like action. Buy this, sell that, move money here. Those ideas work in normal times when the system is stable and the rules are enforced. But collapses don't follow scripts. Tactics depend on timing. They depend on the system functioning just a little longer than you need it to. Miss the timing, and the tactic fails catastrophically. Not slowly, instantly. Principles are different. They don't care about the date. They don't rely on perfect execution. They work whether the collapse is inflation, deflation, default, or reset. That's why they survive when everything else breaks. Tactics change every decade. Principles don't. When systems fail, the first thing to disappear isn't reality, it's paperwork. Currencies collapse, contracts are rewritten, accounts are frozen, promises are broken. Anything that exists only as a number on a screen becomes fragile the moment trust disappears. But physical things don't care. Land doesn't stop being land because a government mismanages money. A building doesn't vanish because a bank fails. A farm still grows food even when currency becomes worthless. In Weimar Germany, people who held savings watched them turn to dust. Years of work erased by inflation. But people who owned real assets, farms, workshops, buildings, survived. The price in marks changed wildly, but the thing itself stayed the same. That's the first principle every collapse teaches. Paper promise burn first. Modern finance is built almost entirely on promises. Stocks are promises of future profits. Bonds are promises of repayment. Bank deposits are promises that your money will be there when you ask for it. Even retirement accounts are layers of claims stacked on top of other claims. In stable times, those promises work. Courts enforce them, banks honor them, governments backstop them, ownership feels real. Until it isn't. When stress enters the system, those claims depend on institutions staying solvent, liquid, and cooperative. And when they don't, the difference between owning something and having a claim on it becomes painfully clear. A house you own is shelter. A house you owe money on is an agreement. A claim is not the same as control. In every collapse, something strange happens to markets. Prices can still exist, charts can still move, but buyers disappear. Because when trust breaks, nobody wants to hold something that only has value if someone else believes in it tomorrow. Speculative assets depend on belief. They work when confidence is high and liquidity is endless. But belief evaporates fast in a crisis. And when it does, speculation has nothing to stand on. Production is different. People still need food, still need shelter, still need heat, repair, transportation. In the Great Depression, stock prices collapsed nearly 90%. Fortunes built on speculation vanished. But farms kept producing. Rental properties kept housing people. Small businesses that provided essentials survived when paper wealth didn't. Collapse removes buyers. It doesn't remove needs. In a crash, nobody wants promises. Modern markets reward speculation when times are good. Prices rise, leverage multiplies gains, and paper wealth grows faster than real output. It feels like progress. It feels like intelligence. Entire careers are built on predicting what someone else will pay tomorrow. But that illusion only works when markets stay open and confidence stays intact. When stress hits, speculation becomes a liability. Liquidity vanishes, buyers retreat. Assets that relied on constant demand suddenly have none. What looked valuable yesterday becomes impossible to convert today. Production doesn't depend on market mood. A business that produces something people need still has customers. A property that provides shelter still has value. A system that creates food, energy, or services keeps functioning even when prices collapse. When markets close, speculation stops. Production continues. So ask yourself one question. What still matters when markets close? Debt feels harmless when everything is growing. Income rises, asset prices climb, payments feel manageable, borrowing looks like leverage a way to move faster, expand sooner, live ahead of schedule. In stable systems, that illusion holds. In collapse, it breaks. When economies contract, incomes fall first. Jobs disappear, businesses shrink. But debt doesn't adjust. The bill arrives on time, every time, regardless of what just happened to your life. Banks don't absorb the shock you do. During the Great Depression, families didn't lose their farms because land stopped producing. They lost them because debt remained fixed while income collapsed. Ownership vanished not through failure, but through obligation. Debt is neutral in good times. In collapse, it becomes a weapon. The bill always survives. Debt only feels abstract until it becomes personal. A mortgage isn't numbers on a screen, it's a claim on your home. A car loan isn't convenience, it's a contract that follows you even if your income doesn't. Credit cards, student loans, leverage, they all assume tomorrow looks like today. Collapse breaks that assumption. When income drops or disappears, obligations stay fixed. Payments don't care about emergencies. Banks don't negotiate with reality. And suddenly, what you thought you owned is revealed to be conditional. If someone else has the legal right to take it, it was never fully yours. Freedom in stable times feels optional. In collapse, it becomes everything. The people who survived weren't always richer. They were lighter. Fewer obligations. Fewer hooks attached to their future. If someone can take it, you don't own it. When everything else is stripped away, something remains. Property can be seized. Accounts frozen, businesses nationalized, borders closed. Wealth, no matter how carefully accumulated, can disappear overnight. History is unforgiving that way. But skills stay. They live in your hands, your mind, your ability to solve problems in the real world. During the darkest collapses of the 20th century, people who lost everything still survived because they could do something useful. Doctors treated the sick. Mechanics fixed machines. Craftsmen repaired what others couldn't replace. After the war, refugees crossed borders with nothing but knowledge and rebuilt entire lives from scratch. Not because they were lucky, but because skills travel when nothing else can. When systems fail, value shifts from what you own to what you can do. So ask yourself the hardest question of all. What survives when everything else is stripped away? When institutions fail, people don't disappear. Banks close. Governments stall. Laws stop being enforced the way they were promised. Systems that once felt permanent suddenly feel distant, unresponsive, overwhelmed. But life doesn't stop. People still wake up hungry. Children still need care. Nights still fall. What changes isn't existence, it's structure. Society reorganizes. In those moments, survival stops being about systems and starts being about relationships. Not contracts, not policies, not accounts. People fall back on what still works when abstractions fail. Trust, familiarity, obligation, and shared need. After the collapse of the Soviet Union, this reality became impossible to ignore. Salaries went unpaid for months. Pensions evaporated. The currency lost meaning faster than official statements could keep up. Stores sat empty. State institutions that once controlled every aspect of life retreated almost overnight. Yet people didn't vanish with them. Families moved in together. Neighbors shared what little they had. Skills replaced money. One person fixed appliances, another grew food, another had connections that mattered more than cash. Survival didn't belong to those with accounts. It belonged to those embedded in relationships. Those who knew people, those people trusted. What mattered wasn't how much you had saved, but how many doors you could knock on without fear. This pattern repeats everywhere institutions weaken. Before modern governments, before centralized banking, before digital systems, nearly all economic life functioned this way. People traded within circles of trust. Credit existed, but it was personal. Obligation was enforced not by law alone, but by reputation and relationship. When modern institutions break, society doesn't immediately descend into chaos. That's a myth. What actually happens is regression, a return to something older, smaller, local, human. Trust replaces policy. Reputation replaces contracts. Community replaces systems. The more distant and abstract the institution, the faster it collapses under stress. The closer and more personal the relationship, the longer it holds. Governments struggle to respond. Corporations freeze. But neighbors still know who needs help. Families still protect their own. Communities still organize quietly, long before official solutions arrive. This is why reliance on distant systems is fragile. If your safety depends entirely on institutions you don't control, understand, or influence, you have no fallback when they fail, no leverage, no redundancy. But if you're embedded in a network, people who know you, rely on you, and trust you, you gain resilience that doesn't appear on balance sheets. These networks don't eliminate hardship. They reduce isolation. They provide options when formal channels close. In collapse, isolation is dangerous. Connection is currency. So ask yourself quietly, before you need the answer. If the systems you depend on went dark tomorrow, no banks, no guarantees, no reliable institutions, who would help you? The most dangerous instinct in uncertain times is waiting. Waiting for clarity. Waiting for confirmation. Waiting for permission to act. People tell themselves they're being responsible, that they're gathering more information, that they'll move once things make sense. They convince themselves that caution is wisdom. But in moments of systemic stress, waiting isn't neutral. It quietly works against you. Collapse never announces itself in advance. It doesn't send a formal warning. It doesn't pause the system and explain what's about to happen. It unfolds while life is still recognizable, while routines still exist, while experts are still debating whether anything is wrong at all. And because uncertainty feels uncomfortable, people postpone action, hoping the picture will become clearer tomorrow. It rarely does. By the time the evidence is undeniable, the landscape has already changed. The easy exits are gone. Assets that once moved freely are suddenly locked behind restrictions. Rules that seemed permanent are rewritten under emergency language. What you assumed was guaranteed is reclassified as temporary. Options that existed quietly, without friction, vanish without ceremony. What once felt like patience reveals itself as delay. And delay turns into loss. History is unforgiving in this way. It punishes hesitation more severely than imperfect action. People who moved early and made small mistakes often survived. People who waited for perfect certainty were forced to react later, under pressure, with fewer choices and harsher consequences. The survivors weren't fearless. They weren't reckless. They didn't have special information. What they had was an understanding that systems fail long before they admit they're failing. Public assurances lag behind reality. Official narratives are designed to maintain calm, not to signal danger. The signals do arrive, but they're subtle, technical, easy to dismiss. Rising debt, quiet policy shifts, temporary measures that don't get reversed. Each signal on its own feels manageable. Together they form a pattern that's only obvious in hindsight. By the time certainty finally arrives, it does so in the form of damage already done. Locked accounts, lost value, limited mobility, forced decisions. Certainty only comes after damage, and once it arrives, it's too late to use it. These patterns aren't new. They don't belong to one century, one country, or one currency. They aren't tied to a specific political system, technology, or generation. They repeat because human behavior repeats. Again and again, across history, the same pressures build in different forms. Debt grows faster than the ability to repay it. Money is diluted to solve problems that should have been confronted earlier. Institutions stretch trust to maintain stability just a little longer until that trust finally snaps. And when it does, the story is always familiar. Currencies fail in different ways, but the outcome is the same. The numbers change, the explanations change, the people in charge change, yet the consequences fall on ordinary lives with brutal consistency. What was once considered permanent is suddenly negotiable. What was assumed to be safe is reclassified as conditional. Rules that felt unbreakable are quietly rewritten. In that moment, the same rules reassert themselves. Hard assets survive. What exists in the real world, what can be touched, used, lived in, or worked with, continues to matter even when accounting systems collapse. Production outlasts speculation. Things that create real value keep functioning when belief disappears. Needs don't vanish just because confidence does. Debt destroy during collapse. Obligations don't adjust when income falls. Leverage that once felt efficient turns predatory when the system tightens. Skills travel when borders close. What you can do retains value even when what you own is stripped away. Skills move where assets cannot. Local trust outlives distant systems. When institutions fail, people fall back on relationships. Survival becomes personal again. None of this requires prediction. That's the mistake most people make waiting for certainty, for a date, for a clear signal that says, now. But collapse never works that way. The exact timing is always debated endlessly, right up until it no longer matters. By the time it's obvious to everyone, the window has already narrowed. You don't need to know whether the system holds together for 5 more years or 15. Positioning according to these principles works either way. They don't require perfect execution. They don't demand flawless timing. They simply align you with what has survived every failure before. That's why they matter. History doesn't repeat, but it rhymes. Not because events are identical, but because incentives, fear, and short-term thinking don't change. The same mistakes are made with new tools and better language. The results arrive wearing different clothes, but they carry the same weight. The only real choice is this: align yourself with what survives, or gamble that you'll outsmart the timing. Most people choose the gamble. Most people lose it not because they were reckless, but because they trusted a system to behave differently this time. If you want to understand the specific tactics that fit these principles in the modern world, what makes sense now, what doesn't, and how to adapt without panic, subscribe. The next chapter breaks that down, because when the window closes, it doesn't slam shut. It closes quietly,